Deferred revenues can also be called unearned revenues. Unearned revenues are basically cash payments received in advance of actually providing a good or a service. So it's cash that's been received but not yet earned. In order for revenue to be earned, the seller has to fulfill their end of the bargain by providing a good or a service. So until that happens, it's considered to be unearned. So some examples are, and these are the flip side of prepaids. So for example, one company will have a prepaid. So prepaid for one company will be an unearned for the other company. So I'll use the example of rent because we talked about prepaid rent also. So if one company has prepaid rent, they will record it as prepaid rent. The company that we're talking about now from the revenue perspective, if they receive that rent payment up front, they have not yet earned that money. So they record that as unearned rent. So then each month as they earn rent, they will record rent revenue and then subtract that amount out of the unearned rent that they've already recorded. So another example would be if a company receives payments for subscriptions, it will remain to be unearned revenue until each magazine or each newspaper is provided. So if a 12-month subscription is paid up front, then each month, 1 month of that revenue will be considered to be earned. And then another example would be receiving consulting fees up front. So if you are a consulting firm and you give advice on management or whatever to different companies, if a company pays you up front for your consulting fees for the next 60 days, that's considered unearned consulting revenue. So essentially, it's just whatever revenue account with the word unearned in front of it. Unearned revenue is actually a liability. The reason that it's a liability is because you as a company have received cash and you now owe something to a customer in exchange for that. So even though you don't owe them cash, it's still a liability because you owe them either a good or a service. So here are the journal entries to record unearned revenue and what happens after that. So initially, when a landlord receives 3 months of rent up front, the initial journal entry would be to debit cash because the landlord is receiving cash payment, but not to credit revenue because at that point the landlord hasn't provided the 3 months of rent for the tenant. So the landlord has to record a credit to unearned rent revenue. So that's the journal entry to record unearned revenue. Then, of course, as time passes, some of that revenue will begin to be earned. So the adjusting entry at the end of each month would be to debit unearned rent revenue because you debit a liability to reduce it. So you're reducing the amount that's unearned and you are increasing rent revenue, which is the account that shows the earned revenue. So after, we'll just say this is after the month of January. So we'll say this took place on January 1st. Then on January 31st, it was recorded to reflect 1 month of rent revenue had then been earned. So after the second journal entry there, the adjusting journal entry, the unearned revenue balance would then be $200. Then at the end of February, you would make this same journal entry again. Then at the end of February, $100 of unearned revenue would be left. Then after March, she would make that $100 journal entry again, and there would be $0 of unearned revenue left. And then at that same time, rent revenue from this transaction would equal $300. So essentially what you're doing is first recording it in unearned revenue, and then each month moving a part of that over to rent revenue as it is earned. Here's an example where we can do the journal entry. Fast Forward agreed to provide consulting services to a client for 60 days for a fixed fee of $3,000, which the client paid in advance. So we'll just say that this is July 1st, and Fast Forward is the company that we're looking at, and they have received a payment, a cash payment. So they debit cash for $3,000. This is not revenue at this point because they've done absolutely nothing to earn it. So it's unearned revenue. Again, that's $3,000. So at the end of 60 days, all of this will have been earned. So we'll just say July, August. We'll say August 31st. They can adjust the books. All of this will now be recognized as revenue. They've completed their consulting engagement. So Fast Forward will debit unearned revenue to reduce the balance by $3,000 and credit revenue because it's now been earned in the amount of $3,000.